fallout of a gold price revaluation will implode the synthetically priced silver market completely.
They now have to keep printing or we crash.
We've got this ticking time bomb.
Talking gold with the one and only Andrew Maguire.
Welcome to Live from the Vault.
Welcome to Live from the Vault from the entire Live from the Vault team. You know, Live from the Vault is the show that goes beyond the headlines and uncovers the truth about the precious metals industry and the effects on the global economy in these historic times. With exclusive access to experts and insiders, we reveal information and insights that you simply won't find anywhere else. Hi, my name is Shane Moran, and as you can see, I'm back in the vault, and I'll be your host for this week's episode. And we'll be joined very shortly here by the one and only precious metals expert and whistleblower, Andrew Maguire, as we pull back the curtains on the intricate world of gold and silver and expose what's really going on in the precious metals industry. So get ready for another blockbuster episode of Live from the Vault, and we'll bring you knowledge and the understanding that the mainstream media just will not provide. So before we get over to Andrew, I just want to make sure that you can help the show out by hitting that subscribe button and the bell notification right there if you want to be notified in real time as each episode goes live. And with that, let's head over to the UK and talking gold with Andrew Maguire. Hey, Andrew, following our recent Bear Trap episode, we've had a lot of subscriber questions that we're going to get to about the short-term action here, but the bulk of the questions, believe it or not, revolved around the effects that the de-dollarisation will have on the gold price. Can we start right here?
Yeah, great to be with you, Shane. Great to be with everybody. Let's get into it. There's so much to go through, and I really hear you on this one. We're going to look at both. So before looking at the shorter-term COMEX-driven casinos, the most active hours, which we're right in the middle of here, and then we'll look at that at the shorter-term COMEX-driven, and of course the active hours are we're evidencing the pit open to pit close selling, and once again today, exactly the same thing. We have the Asian markets coming on, the physical markets buying, and then we get, as soon as the pit opens in New York, immediately we see synthetic selling coming down. And again, this is those CTAs once again getting wrong-footed, and then right to the pit close when the commercials then start ringing the register and short covering. So as I say, these are the useful fools of the casino. And they've been responsible for this entire counterintuitive selling action since our last episode, basically. And that was just 2 weeks ago on the 10th. And of course, this is alongside what we expect as the casino-run February contract actually rolls off the pit managers table next week. Actually, this week. Really, the options expiry is this week, but it rolls off the board technically early next week. And then that means it's either going to be cash settled or stood for delivery. And I want to report on, in the meantime, on the largely unrealized scope of the de-dollarisation process, which, as we're going to assess, is on the front burner. And we're going to look at the impact of this and what it's going to have the impact on the gold, on the gold, and also a more dramatic effect this will have on the related silver markets, which so many people have not even factored in. So we'll take a look at how the de-dollarisation process is actually far more advanced and sophisticated than is currently understood, and how ultimately this process is really running headlong into an unfactored global gold price revaluation trigger into the process, and completely unrealized by the mainstream media shills. We've recently uncovered information, which we're going to share, that indicates China is far more active than it appears. So let's run through what we and our extremely well-connected global liquidity providers are discerning. And first, the undisputed facts. As of December 2023, just a month ago, China reported foreign exchange reserves their reserves totaled $3.24 trillion, which is the highest official foreign exchange reserves of any country, of course. Now, we also vend in the officially stated PBOC gold reserves, which rose by 225 tons officially during 2023 to 2,235 tons. Then on paper, this Chinese central bank gold officially, percentage really it comprises officially 4.3% of these foreign exchange reserves. Okay, so those are the reported facts. So this is where things get really interesting. Although we've been reporting information from our well-connected Chinese contacts, who I will add have time and time again proved to be accurate, including correctly reporting back in 2010 after the IMF refused the PBOC's offer to buy the 400 tons they were trying to sell in 2010. And that was their gold sale. Half of that went to India. And then what they did report at the time, and I remember this live, they correctly reported that China had been forced to go to the market to surreptitiously scoop up what had been discounted gold, because when the IMF announced a gold sale of 400 tons, they did it on a regular, from time to time on a regular basis. Of course, it smashed the price down before they got the sale. Obviously, that's not the smartest way to do it. If they'd have done it quietly, adding into the market, slipping into the market, wouldn't have been a problem. But each time they pre-announced it, why? Get the price down. Ludicrous part of the, and that was the end. That was 2010 was the end of that process. So they reported China was buying, and it into the next 5-year period, their gold holdings didn't move from the stated 1,100 tons. And these same insiders have now been providing us well-sourced empirical data indicating the PBOC reserves salted amongst the state-held banks are now some 20 times greater than reported than this 2,235 tons they report. In their estimation, it's closer to 40,000 tons. Now, but we're also always looking for corroboration of these bullion holding estimates. This is going to be the large focus, actually, of this episode, and it uncovers some interesting stuff. So, given monetary gold transactions do not require reporting due to the fact that foreign exchange gold is categorized as money versus a commodity that is not captured, obviously, through customs data, obviously, in this case, it's money. It suits central banks to keep these unreported foreign exchange gold transactions top secret. And within the data lays a significantly larger ongoing de-dollarisation process, which, as we're going to look at, is not just well embedded, but it's significantly ramping up. We need to pay attention to this. And this is especially important because multiple sources have pointed to similar empirical evidence that vary greatly, but nevertheless aggregate unreported PBOC bullion holdings from between 20,000 tons and 40,000 tons. So if we can to better understand if this is really the case, then the odds of a global South-centric gold price revaluation are significantly brought forward. Now, this is especially relevant as we've already been seen during the first 3 weeks of 2024, the risks of a military conflict between NATO and really the 3 Sino-Russian, Iranian Global South BRICS members greatly raises the odds of a weaponized gold price revaluation trigger point. And we need to be ready, especially those exposed to the siloed COMEX gold and silver markets, which we're obviously going to have to look at shortly. But clearly the scale of such a massive imbalance between the comparatively tiny Western reported and US and European gold bullion holdings versus an estimated potential 60,000 tons accrued by the well-established 2013 Sino-Russian alliance, where they have been combining and utilizing this as a store of value, essentially. ultimately puts these two collaborating central banks in complete control of the real supply-demand price discovery process. Ultimately, it does. Essentially in control of a weaponized gold price nuclear option, should it need it. And we also need to remind subscribers of the PBOC's accessibility to the reported plus 20,000 tons of gold reported as delivered to citizens through the Shanghai Gold Exchange, which is on record. And so they've got access to that if it was needed. And it would raise a potential Sino-Russian aggregated physical holdings to closer to 80,000 tons. Now, we're going to start digging into this in a minute, but as a part of the openly telegraphed war measures that we drew attention to here back, I think it was early 2023 in one of our episodes, it's no coincidence that the PBOC has facilitated a mechanism to commandeer those holdings in a case of war, providing a generous patriotic lease fee, and we talked about how that would work, with a promise to repay the borrowed bullion along with a lease yield directly back to the citizens. So it wouldn't be seized, it would simply be utilized, and it'd be a patriotic measure. Now, while Europe's comparatively tiny aggregated central bank bullion holdings are audited and unlikely to be rehypothecated, they're probably accurate. The same cannot be said of the 8,133 tons of US Treasury holdings, which have not been audited for over 50 years. And we looked in detail at the Fed's refusal back in April 2013 to allow the German Bundesbank to even inspect their US Treasury deposits, followed by the difficulty that Germany had in repatriating this a tiny 300 tons, raised further questions about the integrity of these US reserves. And what is clear and is that any private vaulting facility running into such an obvious interference would have seen their vaults frozen. It would have forced an independent audit. Although several US congressmen, such as Mooney and Ron Paul, have pushed for such an audit, where are the silent mainstream media on this? And without question, every first-tier liquidity provider exposed to the global wholesale markets are of the opinion Fed-controlled Treasury gold has likely got multiple encumbered ownership claims on each ounce and are not a trusted source. So for the very same reason, global central banks are quietly repatriating their gold bullion reserves back into the care of their own jurisdictions. Now, as did Texas, who moved to repatriate its gold all the way back in 2017, having control of their state reserves enabled Texas to recategorize gold as legal tender, so it could actually compete with fiat dollars for money. And now we see 6 other states are moving to do the same. And so really, in summary, if a growing number of US states do not trust the Fed management of US Treasury gold, what does it say about the perceived integrity of the stated 8,133 tons of US gold? And regardless, whichever way you spin it, there's a massive imbalance between Western central banks, Global South central bank, physical gold holdings.
Now, Andrew, this massive disparity between the central bank gold reserves held by the Global South central banks versus what's held by the Western central banks sets the stage for what you've already discovered here that could well back up these disparities. Now, to help us understand this better, can you share this information with us?
Yeah, Shane, this now brings us on to a little reported Bloomberg report, which draws unwanted attention to former US Trade and Treasury official Brad Setster assessment that China's reported US 3.24 trillion of foreign exchange reserves are just 50% of what he estimates, estimating that the PBOC's reserves total closer to 6 trillion, which he expressed as, quote, presenting a new risk to the global economy, end quote. Now, Setster is concerned that China's lack of transparency is a problem, remarking, and there's a quote here, which is directly his words, because China structurally is so central to the global economy that anything it does, seen or unseen, will eventually have an enormous impact on the rest of the world. His comment. Now, as reported by Setster, around half of these additional over 3 trillion of unreported shadow bank reserves are salted amongst the state commercial lenders and the policy banks. However, our focus is on gold. And given that monetary gold reserves are also categorized as foreign exchange reserves, the question is, how much of this massive multi-trillion shadow banking pile salted inside the state-held banks comprises of FX gold that has been converted into physical bars? Now, our well-connected Chinese contacts have for some time been reporting these stealthy dollar to gold conversions, and they stepped up in 2010, but they really ramped up after the dollar was weaponized against Russia in March 2022. And it makes sense that these FX conversions have been channeled into fungible and highly liquid bullion, achieving really two major things: stealthily de-dollarizing, converting incumbent US dollar debt into fully paid for debt-free bullion without raising a red flag, alongside sanction-proofing trillions of dollars of Chinese FX reserves that could, in a time of war or even in a change of an administration, which is possible, be weaponized against China. In fact, it is most likely that a very large percentage of these excess reserves now sit in the form of a massively unreported multi-trillion dollar gold bullion hoard. And while the exact level of unreported bullion holdings is impossible to auditively lock down, the potential is that these unreported state-held shadow bank holdings could equal between plus or minus 40,000 tons, which brings us full circle to jiving with our contacts' observed estimates. There is no other plausible way that China really could, under the radar, have accrued this much bullion in exchange for dollars without drawing attention to this de-dollarizing process. Now, our well-connected Chinese contacts aside, the average of multiple credible sources have estimated China's gold reserves really constitute something around 30,000 to 40,000 tons of gold, which, to stay on the radar for now, are salted amongst these state-held banks and could be crystallized with a click of a mouse. Now, this conservatively suggests that the percentage of gold that backs the aggregate total of reported and this is Setster's reported 6 trillion assessment of China's FX reserves, is plausibly closer to a staggering plus or minus 40%, alongside what could be estimated to constitute the highest global to GDP ratio of all central banks, multiples of the European gold to GDP average of around 4%. Now, if you recall, Shane, in our last episode, we looked at the ramp up and the potential scale of this de-dollarization process and why, Taiwan escalations aside, it doesn't suit China to shoot themselves in the foot by invoking the nuclear option of openly dumping treasuries. And what is becoming clearer, though, is that China has, through their secretive shadow banking operations, been stealthily converting a large percentage of these hidden 3 trillion of largely dollar FX holdings into physical gold. And once this is ultimately revealed, the price of gold will far exceed Saxo Bank's $3,000 per ounce 2024 estimate, likely placing this as a floor to actually rally off, which is kind of what I was alluding to last episode. Now, if it needed to be invoked, the nuclear option is for the Sino-Russia alliance to openly revalue their gold reserves, which, to avoid a related interconnected currency breakdown in the other global foreign exchange currency crosses, which gold is, would trigger every other global central bank to also revalue their central bank gold reserves, a process that, as we've talked about before, can be done with a click of a mouse. And as we previously outlined in a couple of other episodes, this can be effected by central banks simply selling existing undervalued gold revaluation account, gold holdings in that account. Say, and it's pretty much, let's say, liquidity provider's figure is probably valued around $1,200 for the European central banks, and then to sell, and then literally, then into a bid-only market, immediately rebuy the same number of ounces back at market. So it could be $2,500, it could be $3,000, instantly crystallizing a gold asset gain, bolstering their GDP gold correlation, which should be supportive of their currencies, and really locking in a new floor for the price of gold. Notably, at this point, every central bank without exception would benefit from a higher gold price. And clearly this process would once and for all eliminate non-Basel III compliant paper gold as a tradable asset class. It just wouldn't stand up. So where does this leave the Fed, who really, since Nixon withdrew the convertibility of gold for dollars at a fixed price, that was in 1971, in their efforts to synthetically support the dollar as benchmarked against revealing gold, remains the only central bank that has continued to bet against gold. And since Basel III compliance turned gold into a first-year asset class 1 year ago, they have not stopped. And as we previously assessed, the only backdoor for the Fed to avoid exposing the degree of rehypothecation of multiple ownership claims on the reported 8,133 tons of Treasury gold would be to also revalue gold from its current Treasury price of $42 for an ounce. Whatever the price, it's going to be at whatever the price the Sino-Russian alliance revaluation price settles at. If they didn't do it, every global central bank would repatriate their gold, bankrupting and exposing the Fed's gold rehypothecation fraud.
Wow, man, that's unbelievable. Andrew, now you had mentioned that you would look at how the gold price revaluation would impact the U.S. traders who are locked inside the Fed-run COMEX casino. What are you expecting here?
Yeah, that's a serious question too. And I get a lot of questions around this from US traders forbidden from accessing the global over-the-counter spot markets, who are going to be exposed to how the House deals with a massive price reset. And we'll look in detail at the likely impact a gold revaluation will have on the non-Basel III compliant CME exchanges shortly, but to provide full context, we should really continue just quickly to look at the scope of this current de-dollarization process, because it really gives us an idea of the speed of this. Nuclear options aside, China is openly easing their oil trade out of the dollar into competing BRICS currencies, alongside increasingly offering full-blown yuan banking accounts in Africa. And while this has been played down by the news services, and given the growing weight of evidence indicating that the PBOC have very likely accrued plus or minus 40,000 tons of physical gold reserves, plus the accessibility to Russian gold assets, alongside the potential war measures that could enable them to also collateralize 20,000 tons of citizens' gold, China will greatly profit from acting alongside Russia as a key liquidity provider to back the outlined sanction-proof BRICS gold-backed commodity currency. Now, the moment that Glazniev's gold-backed currency is formalized and our contacts do continue to promise us further updates of this is one, we'll do that very soon, China is increasingly adopting this sanction-proof for oil for gold trade. And we looked at the scope of this multi-trillion-dollar oil energy trade last episode and the massively inflationary effects oil and energy and grain priced in revalued gold grams will impose on central banks who have insufficient gold to act as a counterparty. So this is a huge story. So to answer your question, Shane, let's look at the impact of the gold price revaluation on the global exchanges. Now, due to its leverage structure, the CME's COMEX future exchange will be exposed as the only remaining non-NSFR compliant gold exchange. In order to survive, paper gold positions would have to become deliverable and able to be delivered at a net stable funding ratio compliant global price. Global price, of course it would. This would force margined, that is, fractionally backed gold loans issued by the casino to clients to be called in. Far more impacting the shorts, who would be forced to cash settle highly leveraged undeliverable positions being called in by the house, who will themselves be exposed to matching globally settled revaluation prices. Or they would be drained of every last ounce, kilo, or ton by way of a massive exchange for physical withdrawal. And we've previously assessed this EFP backdoor is the paper market's Achilles heel. And if it was frozen, it would effectively, under the COMEX casino, what it would do was render them dead in the water. The CME cannot allow this to happen. But in order to survive as an institutional futures exchange, they will throw the poorly structured speculators under the bus. So really, to kind of sum it up, into a gold price revaluation event, the COMEX would go bid only until a real tradable, globally accepted physical price would emerge. And if the CME chose to call a force majeure by cash settling longs and shorts before allowing them to make good on their bets, it would collapse good faith in the entire suite of CME's related products. That ain't going to happen. Although, really, on the right side of the revaluation event, margined longs, i.e., those that had bet for a higher gold price, they have to get prepared to fully fund current margined positions. So unlike shorts, who will be called on to stump up physical delivery of previously borrowed and short sold warrants at pre-revaluation prices into a bid-only market, forcing unlimited losses far beyond the bullion warrants that were borrowed from the house and then sold. However, the margined longs who didn't want or had insufficient funds to meet a forced one-to-one margin requirement or have the funds to take delivery would be cashed out at, this is important, at a higher globally driven, spot-driven price. Or they could use price gains to cut their long exposure so as to stay in the game into a bid-only scenario. That would be at the expense of the shorts. Now, the COMEX circuit breaker halts would provide stage exit points, but as we previously warned, some brokers could fail. So please check with your broker. I've said it multiple times. Check with your broker your funds are segregated, because brokers are not structured for this either. So what does this actually mean? The current margin borrowing cost to control 100 ounces of COMEX gold, which is valued right now up or down by about $205,000. You really just need $8,300 per contract, which is just 4% of the real value of this contract. However, when called upon to stump up the remaining 96% to meet margin requirements, the gold price benchmarking the value of each contract would also have risen, and most likely into a bid-only market be as high as $3,000 an ounce, equating to about $300,000 per contract. So if one-to-one margin requirements were unable to be fulfilled, excess longs would be cashed out at a higher market price at one of the stages, the market halt stages. Now, this would still benefit longs who, looking at the current ranges, would have plus or minus gain of $1,500 per ounce potentially, times 100 ounces, which is 150,000 to cash out. Or they could use that to one-to-one fund fewer contracts. So if you had 10 contracts or 5 contracts, you could lower the amount of contracts you had in play and cash out the rest. Or stand for delivery, of course. Now, shorts would not find an easy exit, as each market halt would be followed by a bid-only follow-through into a bottleneck of shorts scrambling to mitigate losses. Many will be bankrupted.
Wow, that's amazing. And another reason why you can't get this information anywhere else except right here on Live from the Vault. Now, Andrew, how would all of this impact silver?
Yeah, Shane, this is where it gets really funky. The fallout of a gold price revaluation will implode the synthetically priced silver market completely. Currently, in order to control one 5,000 ounce contract of silver, the CME requires a tiny 9,000 bucks maintenance margin on deposit. And given the advantage of the house managed illegal position concentration, which Art Chilton talked about, it's been agreed multiple times that they have an excess position concentration, which is illegal technically. This enormous level of leverage is how the house market makers, the silver pit managers, have been able to control the massively paper diluted silver market against this scattered group of speculative commodity trading advisors. Now, first-tier liquidity providers are not stupid. Guess who's going to be on the wrong side of these bets? And currently, so a 5,000 ounces of silver is valued around 115,000 bucks, and to control it, the tiny 9,000 bucks borrowed from the house to control each contract is historically around 8%. The implications for silver are enormous. As a result of the house running a massive leveraged, multifaceted, concentrated derivative book on these contracts, silver has become the most undervalued commodity on the planet Earth, purely synthetic. A gold price revaluation would break the ratio trade these insiders rely on to contain these purely synthetic silver contracts, likely reverting the current ludicrous 90-to-1 ratio, 90 ounces of silver to buy 1 ounce of gold, closer to more like 15-to-1 or lower. Disbanding this ratio trade in itself would raise the price of each silver contract currently contained to the low 20s to about plus or minus 200 bucks an ounce. This would likely force the 8% margin to increase to, at best estimate, 50% or to as high as 100%. Once again, longs would have an edge over the shorts here. So if we took 3,000 gold as the revaluation point, the completely synthetic derivative determined ratio trade would be blown out of the water. The short gold or silver ratio legs would be caught up in the underlying volatility, and both sides would scramble to square positions as the entire precious metal derivative complex collapsed into absolutely unfactored, unknown territory. One way or another, once silver rises above the technical and cartel defended fracture point of 35 bucks, derivative determined ranges would implode, triggering a bid-only short covering ramp well in excess of the 2011 50 bucks highs. So, who would be caught out into this revaluation? Every single CTA, commodity trading advisor, who has naked short sold gold. Naked in so much as while their COMEX shorts are backed by dollar longs, these debt-laden fiat longs don't represent a deliverable NSFR compliant gold price when called upon for delivery. So in other words, when unleveraged gold bullion is demanded for delivery, it is just going to take many more depreciating dollars to buy these same fully paid for COMEX ounces, kilos, tons on the other side of these paper bets. When delivery of these paper back shorts is then called in, this is when we will see the chaos unfold.
Wow, that's amazing. Now, Andrew, in the last couple of weeks, the theme of a lot of the questions that came in kind of held around like, what are you expecting like more immediately? What's happening right now in the markets? Can you address that?
Yeah, and I will say, look at the action today. I mean, it's typical pit open to pit close selling. And so again, if you're a stacker, this counterintuitive, officially driven, heavy 2024 action has provided you a wonderful bargain basement price. And if you are mirroring what the central banks and the sovereigns and deciders are doing, which is converting depreciating dollars, pounds or euros into bullion, then you're doing exactly what the smart guys are doing. And if you want to drill down, let's face it, we all love a bargain. But let's now look at the current counterintuitive action and what we should expect into the end of the month, as these fractionally backed casino contracts have to be fully funded into readiness for delivery into the end of the month, as well as the progression of gold into the first quarter. Now, we're recording this episode on Wednesday, the 24th, and since our last episode, where we noted that the easily led CTAs, who are the counterparties to the House insiders, betting long against them, we talked about them being led into a bear trap. Well, as is always the case, these momentum-chasing useful fools are massively wrong at both ends of a momentum-chasing cycle. And what we see now is when these shorts turn around to exit this bear trap, they'll find the back door is slammed shut. And the action that we have witnessed since our last episode, recorded on the 10th of January, when gold was at 2026, 80, it fixed at that price then, and we've seen intraday volatile CTA rinsing aside. I mean, basically, it's gone sideways since into our episode here on the 24th. So the action is just a culmination of the officially driven PSYOPs operation we've really experienced from the open of 2024 trading. Both gold and silver futures have been driven into fundamentally as well as technically oversold bargain basement conditions. Now, the reason gold has gone sideways, despite the concerted, officially attempted PSYOPs operation to sell gold against the dollar, has been limited to influencing the non-sticky CTAs, who every single pit open have sold gold and silver into every single pit close. But the selling has been insufficient to offset very large central bank and safe haven physical demand, which is why a very large central bank spot orders at spot 2000 have really had insufficient CTA open interest to come in to actually let them dare to run through what are very, very large central bank orders sitting at that level. Conversely, they've been capping 2050 because that is where central bank buy stops are. So you've kind of got this range where they've really, in other words, hence this synthetic range. So gold's paper-driven, highly counterintuitive heavy action is calling gold for a powerful rebound value, which is really structurally similar to what was triggered in, we had a $59 short squeeze from, it was 1987.50 to 2046.90 on the 13th of December. So really, it's been really, this is where it's been contained back into that range for options purposes. Now, the silver action illustrates just how broken the silver market is. And just as we've identified, the 100% synthetic ratio trade, where in this la-la land derivative world, we're supposed to accept that it takes 90 ounces of silver to buy an ounce of gold, when the real ratio is 8-1. So into this ludicrous silver action where soft retail silver demand has fooled the CTAs into selling rallies and just chasing a dot on a screen, they're completely blinkered to the wholesale 1,000-ounce bars getting very tight. Now, we've evidenced massive Indian buying, which by Monday, a couple of days ago here, evidenced Indian buys calling around the desks to access as many LBMA bars as they can above spot. Very unusual, because they are usually able to access silver below spot, and this wholesale market spillover began to get reflected in Monday's massive 503.9 tons of SLV inflows. It says it all. Now, look, the message I'm sending is one really of wealth preservation. And the message is de-dollarisation and a gold price revaluation is on the front burner. And the reason I have been really put this on the front burner is that unfactored geopolitical escalations raises the odds of it coming when everyone least expects it. So really, the only question is left: how much physical gold and silver, guys, do you own?
Absolutely. Thank you, Andrew Maguire, for talking gold. And remember, to our entire Live from the Vault community, buy physical and make sure it's backed 1-to-1, and understand the difference between what Andy affectionately calls the casino paper gold and silver markets and the actual physical gold and silver markets. They're not the same. Don't be fooled. And there you have it. That's all we have for you today on another fascinating episode of Live from the Vault. Now, please help keep spreading the word about this channel by hitting that like button right there. Share this information and subscribe if you haven't already done so. And if you click on that bell right there, we're going to notify you as each episode goes live. And with that, we'll see you next time right here on Live from the Vault. See you then.